Assalamualaikum, Pak Imam.
Waalaikumsalam warahmatullahi wabarakatuh.
Okay. Can we start now, Pak Imam?
Yes, please.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh.
Very good afternoon, dear participant of the third International Training for Young Islamic Economic Leaders, organized by Department of Economics, Faculty of Economic and Business, Universitas Muhammadiyah Jakarta. First of all, let's thank to Allah Subhanahu Wa Taala who has given us the message and blessing today. So we can meet
di kantor.
sisters and brothers at the seventh public lecture series on risk management under the Appeals 2020. Secondly, may salat and salam always be delivered toward our Prophet Muhammad Sallallahu Alaihi Wasallam and his companions and his ummah who has been following him. And thirdly, I would like to express thanks and appreciation to Dr. Imamudin Yuliadi, who has been with us today for giving his thoughts and share his humble ideas concerning the risk management on Islamic banks. And fourthly, again, welcome again to all dear participants who have consistently attended the series of risk management lectures that we have had so far. Okay, dear participants, we only has around maybe 1 hour for the discussion today. And before we start, could please I introduce our honorable speaker. His name is Dr. Imamudin Yuliadi. Currently, he is our head department of economics, Department of Economics, Faculty of Economic and Business, Universitas Muhammadiyah Jakarta. And Dr. Imamudin Yuliadi has finished and completed his academic background for his undergraduate studies and master degree at Gajah Mada University, majoring in economics. And he had completed his PhD also in economics from Pajajaran University, Bandung. And he has written so many books, particularly in the area of macroeconomics, monetary economics, and also Islamic economics and finance. And he has been teaching at Universitas Muhammadiyah Jakarta for more than 25 years. So inshallah, Dr. Imamudin will discuss with us the issue on risk and return on banking sectors. Okay, Dr. Imamudin Yuliadi, maybe you have around 30 minutes or up to you, so you can share your slides and discuss with us about your topic. Time is yours, Dr. Imamudin, please.
Okay, thank you, Mr. Dimas Bagus Wiranata Kusuma. How are you, everybody? Alhamdulillahirabbil alamin. Assalamualaikum warahmatullahi wabarakatuh. Alhamdulillahirabbil alamin wassalatu wassalamu ala asrofil anbiya'i wal mursalin wa ala alihi wa ashabihi ajma'in. Alhamdulillah, all praises and graduate are offered to Allah Subhanahu wa Ta'ala, who has created this universe and given us
Pak Imam, could you unmute your voice first?
Oh, sorry. Okay. Assalamualaikum warahmatullahi wabarakatuh. Alhamdulillahirabbil alamin wassalatu wassalamu ala asrofil anbiya'i wa ashabihi ajma'in. Alhamdulillah, all praises and graduate are offered to Allah Subhanahu wa Ta'ala, who has created the universe and given us mercy and blessing until we are able to stay and pay attention in forum of IT years. Okay, today I would like to deliver the topic risk and management relationship. Yeah. Before we start this presentation, so we have to understand what is the meaning of risk management. Okay, yeah? Risk management occurs everywhere in the realms of finance. It occurs when an investor buys bonds, offer corporate bonds, when a fund manager has his currency exposure with currency derivative, and when a bank performs a credit check on an individual before issuing a personal line of credit. Stockbrokers use financial instruments like options and futures, and money managers use strategies like portfolio diversifications, asset allocations, and positioning sizing to mitigate or effectively manage risks. Inadequate risk management can result in severe consequences for companies, individuals, and the economy. For the examples, the subprime mortgage meltdown in 2007 that helped trigger the Great Recession stemmed from bad risk management decisions, such as lenders who extended mortgage to individuals with poor credit, investment firm who bought package and issued this mortgage, and funds that invested excessively in the respected but still risky. Okay, total risk, yeah, total risk. The total variability in returns of security represents the total risk of that security. Systemic risk and unsystemic risk are the two components of total risk. Thus, total risk consists of systematic risk and unsystematic risk. Okay, it is can impact about the returns at every investment actions. Yeah, okay. The next, risk associated with investments. Yeah, that consists of systematic or non-diversifiable. Yeah, reversible. Yeah, systematic non-reversible is also there are relationship between risk and also non-systematic or diversifiable. There are approximately between risk and non-systematic or diversifiable. Okay, when we take the investments, beside we have to get the returns, we also face the cost of risk. In general, the more an active fund and its managers shows themselves able to generate alpha, the higher the fees they will tend to charge investor for exposure to those higher alpha strategies. Okay, yeah. Okay, next. What is the meaning of systematic risk? When we discuss about the systematic risk, it is related about the portions of the variability of returns of a security that is caused by external factors is called systematic risk. And also systematic risk known as market risk or non-diversifiable risk. in the economic and political instability, economic recessions, macro policy of the government, etc. It is some phenomena in the economic that can back the price of all shares systematically. Thus, the variations of return in shares, which is caused by this factor, is called systematic risk. Yeah, for a pure passive vehicle like an index fund or an exchange traded funds, you may pay, for example, 15 to 20 basis point in annual management fees, while for a high octane hedge fund employing complex trading strategies involving high capital commitment and transaction costs, an investor would need to pay 20 basis point in annual fees plus give back 20% of profit managers. Okay, next. You can see from this slide that some factor that can influence or related about the systematic risk. You can see, yeah, for example, war-like situations. Yeah, this also can make the systematic risk. Yeah. Risk due to inflation, interest rate risk, political risk. Yeah, you can see, yeah, instability conditions of political and social aspect in one countries can make, yeah, influence the conditions of investment. And also the market risk, yeah, increasing and decreasing the price of investment, yeah, or asset, yeah. Risk due to government policies. Yeah. We don't know the kinds of government policies, yeah. Okay, yeah, because governments like the policies depend on the situations at this time, yeah, and we don't know how about the condition at this stage. Okay. And also natural calamities, yeah, scams, monsoons, industrial growth, international events, yeah, like in the current conditions, yeah, almost all of countries in the world, yeah, face the pandemic COVID-19, and we cannot anticipate, yeah, exactly, yeah, and everyone, every countries, every governments in the world make the, yeah, appropriate, yeah, policies to anticipate these conditions. Okay, it is some situation and condition that can influence the systematic risk. Yeah. Okay, next. How about the non-systematic risk? The return from a security sometimes varies because of certain factors affecting only the company issuing such security. Examples are raw material scarcity, labor strike, management efficiency, etc. Okay, this non-systematic risk. Why? Because we can maintain, yeah, we can manage these conditions. And when variability of returns occurs because of such firm-specific factor, it is known as unsystematic risk. The difference of pricing between passive and active strategies, or beta risk and alpha risk, respectively, encourage many investors to try and spirit this risk. They try to pay lower fees for the beta risk, assume and concentrate their more expensive exposure to specifically define alpha opportunity. This is popularity. This is popularly known as portable alpha. The idea that the alpha component of a total returns is split from the beta component. Okay, it is related about the risk and return. Okay, next. How about non-systematic risk and factor that can influence the non-systematic risk? You can see from this slide here, business risk. Yeah, business risk. It is one factor that can influence the non-systematic risk. Yeah, you can see. Yeah, sometimes the performance of business is up, sometimes it's down. Yeah, this. Yeah, sometimes can get the profit, sometimes get the loss. Yeah, and also financial risk. Yeah, financial risk related about the exchange rate, for example. Yeah, sometimes we face the conditions of depreciation, and the other time we face the conditions of appreciation. Yeah, okay, this one, the non-systemic risk. Risk due to uncertainty. Yeah, risk due to uncertainty. Okay, and also dispute. It is some factors that the component of non-systematic risk. Yeah, in the investment. Okay, next. You can see, yeah, the relationship between risk return relationship of different stock. Yeah, risk return relations of the different stock. Yeah, the horizontal axis, yeah, is the degree of risk, and vertical axis it is rate of return. And there are positive relationship, yeah, between risk and return. If investor want to get more return, so he have to face more risk. Or reversely, yeah, when investor get the risk, get more risk, more get risk, so he get more return. Okay, yeah, like the market line, yeah, you can see debenture with floating charge, or mortgage loan government stock. Yeah, it is risk-free. Unsecured loan, subordinate loan stock, preference shares, ordinary shares. Yeah, okay. It is the relationship, yeah, between risk and returns. Yeah, it mean the good investment, the actions of investment not placed in one place of investment. Yeah, we have to a variety of investment. Yeah, variety of investment, not placed in one place, one kinds of investment. Yeah, it is the strategy to share, yeah, the risk. Yeah, to share the risk. Okay, next. Yeah. How about the relationship between risk and returns? So you can see, from this analysis, risk and return analysis. Yeah, return on security single asset consists of two parts. Yeah, return on security if single asset, yeah, consists of two parts. The first is dividends, and secondly is capital gain rate. Okay, it is the component of returns. Yeah, investor want to increase the return, yeah, both of increasing dividend and also increasing the capital gains rate. Yeah, capital gain rate. So you can see from this formula that returns equals, yeah, T1 it is the dividends, and the capital gain rate. Capital gain rate, it is the gap between price in one time minus the price in the before price. Okay, current price and before price. Okay, it is rate of return in year one. Rate of return in year one. And D1 it is dividend per share in year one. P0 it is price of share in the beginning of the year. For example, in 2018, and P1, P0 it is price of share in the beginning of the year, and P1 it is price of share in the end of the year. For example, P0 it is in price of share in the 2019, and price 1 it is price of share in the 2020. Okay, so it is the factor that can influence how about the return. Okay. Next. And how about the average rate of return? How about the average rate of return? Because investor can get the returns of the exchange of investment. It is in the long time, not in one time, not in 1 year, but maybe in 10 years, or 20 years. So more time to time, how the return is increased, more increase and increase. And from this phenomena, we can calculate the average rate of return. How about the formula to determine the average rate of return? You can see from this slide, the formula of average rate of returns. R bar equals, it is the 1 per n sigma T equals 1 n and RT. R bar represents average rate of return. RT, it is the realized rates of returns and periods 1, 2, and next year. And represents total number of periods. If 10 years, so and it is 10. Okay, it is the formula to determine the average rates of returns. More increase the realized rates of returns, more increase the average rates of returns. And more longer the periods of investment, potential to decrease the average rate of returns. So if we discuss about the average rates of return, so we have to understand the terminology of grace period, grace period or payback, okay, payback methods, to calculate the potential returns of the investment. Okay, next. Risk, when we discuss about risk, risk refers to dispersions of a variable. It is measured by variance or standard deviation, deviation standard of deviance, variance, standard of deviance. Variance is the sum of squares of the deviations of actual returns from average returns. It is the component to users to understand about the risk. So you can see that variance, it is the sigma return in I minus returns in one time, yeah, square. And standard deviations is variance, yeah, equals, yeah, the subscript, the 1/2, yeah. Okay, it is the factor that can influence of risk. Okay. Next, how about the expected rate of return? Yeah. It is the weighted average of all possible returns multiplied by their respective probabilities. Yeah. Expected rate of returns, yeah, equals the returns in the period 1 times the probability of occurrence of time of period 1. Yeah. Depend on the timelines, yeah. If until 10 years, so we have to sum, yeah, the components of the expected rate of returns, yeah, until 10 years. Okay, where R1 is the outcome, y P1 Pi is the probability of occurrence of I. Okay, next. Okay, all participants, yeah. The variance is the sum of squares of the deviations of actual returns from expected returns weighted by the associated probabilities. As you can see, yeah, from this slide, the formula to determine the variance, the sigma, yeah, of standard deviations, yeah, to calculate the expected returns weighted. Okay. Next. Ladies and gentlemen, all participants in the ideals, yeah. One aspect of investor before we make decisions to invest, yeah, in one asset, yeah, in one alternative investment. So we have to understand about the portfolio. Okay, what's the meaning? What is the portfolio? Okay, a portfolio is a bundle of individual assets or securities. Yeah. Bundles of individual assets or securities. Yeah. It is one aspect in the risk management. Yeah. Because in the risk management is the process of identifications, analysis, and acceptance or mitigations of uncertainty in investment decision. Risk is inseparable from returns in the investment world. A variety of tactics exist of a certain risk. One of the most common in standard deviations, a statistical measure of dispersions around a central tendency. Okay, beta, also known as market risk, is a measure of the volatility or systemic risk of an individual stocks in comparison to the entire market. And alpha is a measure of excess returns. Money managers who employ active strategies to beat the market are subjects to alpha risk. Okay, it is the additional explanation about related about the risk management. Okay. All investors hold well diversified portfolio of assets instead of investing in a single asset. If the investor hold well diversified portfolio of asset, the concern should be expected rates of return and risk of portfolio rather than individual assets. Okay, next. Portfolio return to asset case. Yeah. The assumptions the investor face to alternative investment. We rely in the two asset case. The expected return from a portfolio of two or more securities is equal to the weighted average of the expected returns from the individual securities. You can see the sigma RB represents expected return from a portfolio of two securities consists of VA times RA plus VB times RB. VA, it is the proportions of funds invested in security A. WB, WB proportions of fund invested in security B. RA equals expected returns of security A. RB represents expected return of security B. So you can see the assumptions WA plus WB equals 1. Okay, it is the explanations and also the formula that can influence the expected return from a portfolio of two securities. Okay, next. How about the portfolio risk when we face two assets? Okay, since the securities associated and a portfolio are associated with each other, portfolio risk is associated with a covariance between returns of securities. And you can see the formula to determine covariance, sigma E equals 1, RXE minus A RX times RYE minus expected RY times PY. It is, you can directly see in this slide here the formula to determine the covariance XY. Okay, next. And the correlations, because we discuss about the relationship between risk and return, so we have to understand about the correlations between returns of securities. To measure the relationship between returns of securities, so we have to rely the formula of correlations. Correlation X and Y, you can see. This formula, the covariance XY divided by standard deviation of X and standard deviations of Y. And the value of correlations coefficients range between -1 to 1. Yeah. It is the range of correlation coefficient. Okay. And the diversifications has benefits when correlations between returns to assets is less than 1. Yeah. Okay. It is the indicators, yeah, about the diversifications as benefit, yeah, when correlations between returns of asset is less than 1. Okay, next. Okay, the diversification of risk. Okay, yeah, it is the tactics, yeah, in the investment, how we make diversifications of risk, yeah, the actions of investment not takes in one kind, yeah, of investment, yeah. So we have to make diversifications of investment, yeah, to diversification of risk. Okay, how about the diversification of risk? We have seen that total risk of an individual security is measured by the standard deviation, or which can be divided into 2 parts: systematic risk and unsystematic risk. The total between systematic risk and unsystematic risk, it is the total risk. So you can see that total risk, yeah, consists of systematic risk and unsystematic risk. Okay. Next. You can see, yeah, how about the performance of, how about the conditions of systematic risk and unsystematic risk, yeah. The horizontal axis represents number of security, and vertical axis represents risk. Yeah. More increase the number of security, more decrease unsystematic risk, yeah, near the level of systematic risk. Yeah. In the long term, the levels of systematic risk equal the unsystematic risk in the long term, in one time of the long term. Okay. And how about the condition of systematic risk? Yeah, you can see constant. Yeah, there are no relationship between number of security and the level of risk. Yeah, condition of risk. Yeah, there are no relationship between number of security and risk. It is the characteristic of systematic risk. But unsystematic risk more increase the number of security, more decrease the level of risk. Yeah. So you can see the reduction of risk through diversifications. Yeah, it is the tactics of investor to anticipate the conditions in the market, yeah, or in the investment. Yeah, how we can make the diversifications of risk. Okay, next. Only to increase the number of securities in the portfolio will not diversity in the risk. Securities are to be selected carefully. If two security returns are less than perfectly correlated, an investor gains through diversification. It is, yeah. And how about if two securities, M and N, are perfectly negative correlated, total risk will reduce to 0. Okay, so you can see, yeah, the matrix, yeah, the conditions about the times and M, N, and mean of return. Yeah, the column, it is times, and line, yeah, M, N, and mean return. You can see. How about the M? Yeah. More time, yeah, from T1, time 1, time 2, time 3, time 4, you can see. They are unstable, yeah. From T1 to T2, there are increasing, yeah, 10% to 20%. After that, you can see it is decrease, yeah, from T2 to T3, and increase from T3 to T4. Yeah, it is the condition in M. How about in N? You can see from T1 to T2, there are decreasing from 20% to 10%. After that, from T2 to T3, there are increasing from 10% to 20%. And then decreasing from T3 and T4. Okay, so the mean return, yeah, mean return, yeah, M plus N divided by 2, yeah, you can see it is constant, yeah, 50%. It is the explanations about the diversifications of risk, yeah, diversifications of risk, yeah. Okay. Next, you can see, yeah, there are fluctuations, yeah, there are fluctuations. When M increase, N is decrease. When M up, N is down. And reversely, when N up, M is down. Yeah. Okay. It is the related, yeah, between M and N. Yeah. If R minus 1, perfectly negatively correlated, risk is completed, eliminate 0. If R equals 1, risk cannot be diversified. If R less than 1, risk will be diversified away to some extent. It is the performance, yeah, about the diversification of risk in the risk management. Okay, next. Ladies and gentlemen, all participants in the ideals, there are two important findings from these explanations. Yeah, more number of securities will reduce portfolio risk. Yeah, it is the findings, yeah, the important findings. Yeah, more number of securities will reduce portfolio risk because we can diversifications of risk. Securities should not be perfectly correlated. Yeah, securities should not be perfectly correlated. Okay, next. Return distributions for two perfectly negatively correlated stocks. Yeah. Stock W, stock M, and portfolio WM. Yeah, you can see. If you combine the performance of stock W and stock M, so we can make, we can get the result. There are stable constant. Why? Because in the same period, when stock W drop, or decline, so the stock of M is up. And the other periods when stock W up, in the same period, the stock of M is down. It is the correlated here between stock W and stock M. So when we combine between stock W and stock M, so we can take the portfolio WM is constant in the levels 15, the levels of the level 15. Okay, it is the return distribution for two perfectly negatively correlated stocks. Okay, next. And return distribution for two perfectly positively correlated. Yeah, you can see there are perfectly positively correlated stocks, between stock M and stock M accent. You can see when stock M is up, it is the performance, about the stock M, sometime up, sometime down, because the operations of the systematic risk and unsystematic risk, influenced by some factors, like the government policies, the market risk, financial risk, the international issues, and so on, so can impact the up and down, the returns distributions, So what happened about the returns distribution for two perfectly positively correlated stocks? Stock M up, sometimes stock M is down. Okay, and stock M accent is also, So you can see the result of portfolio M and M accent is equals with the performance of stock M and stock M accent. It is the meanings of return distribution for two perfectly positively correlated stocks. Okay, next. Diversifications. It is the important terminology, It is the important terminology in the investments to anticipate the risk, in the investment. It is the actions, it is the tactics for all of investor, to anticipate the systematic risk and unsystematic risk. Diversification, does it always work? Okay, diversification is enhanced depending upon the extent to which the returns and assets move together. This movement is typically measured by a statistic known as correlations, is shown in the figure below. Maybe, like in the left side slide, display, there are perfectly positively correlated, between time and returns, between stock M and N, there are similarly the rules, the rules fluctuations, of stock M and N, the relations between time and returns, you can see, perfectly positively correlated, between time and return, between stock M and N. On some time, maybe there are perfectly negatively correlated between time and returns, among stock M and N, When the stock M is up, in the same period, the stock of N is down. And reversely, when stock of N is up, in the same period, the stock of M is down. So there are negative correlated, perfectly negative correlated, between stock M and N. It is the explanations to show us the relationship between time and returns. Okay, so we have to understand about the roles, relationship, in the risk management. Okay, next. Returns distributions for two perfectly positively correlated stock. It is, Okay, I'm sorry, even if two assets are not perfectly negatively correlated, an investor can still realize diversifications, benefit from combining them in a portfolio, as shown in the figure below. It is when asset F, the assumptions there are two assets, it is one strategy to diversifications investment, There are two assets, asset F and asset F. How about the performance of returns, in asset F, And how about the relationship between asset F and asset K? There are negative, There are negative, perfectly negatively correlated between asset F and asset K. Why? Because when asset F is up in one period, so in the same period, the relationship between time and return in asset K is down. And when asset K is up, relationship time and return. So in the same period, the asset F is down. So we have to combine them, in portfolio, So you can see, in the right side, portfolio of asset F and K. We can reduce, we can reduce the risk, and also the portfolio of asset F and K. Okay, next.
This is the last one, Pak Imam.
Okay, everybody, all participants of IT Yields, it is the materials about the risk and returns relationship. There are the relationship between risk and returns, and we have to make diversifications, when we want to take the investments to anticipate, the systemic and unsystemic risk. Okay. It is my presentations, and I will back to Mr. Dimas Bagus Firanda Kusuma. Okay, thank you. Assalamualaikum warahmatullahi wabarakatuh.
Participants, I know that you following what Dr. Imam explained just now, and you see that Dr. Imam interestingly discuss and explain about the way how we relate about risk and return in such particular portfolio, whereby his presentation is a little bit technical, and there are some calculation formulas, that show us whereby the risk and return are related to each other. In particular, if you look at the characteristic of banking operations. Okay, dear participants, we have around 10 to 15 minutes left, because today is Saturday, and tomorrow is the holiday, perhaps. So maybe you need some preparation on that. Okay, if you have some questions, please identify your name and then your affiliation and mention your questions, please. Any comments, dear participants? Maybe sisters from Malaysia or from Africa here. I found so many names from Africa and from Malaysia, or maybe from Indonesia.
Yeah.
Okay, please, brother.
Dimas. Shall I come in?
Yes, please.
Okay,
Please.
please.
We can hear your voice.
Okay, thank you. Assalamu alaikum wa rahmatullahi wa barakatuh. Thank you very much for giving me the floor. Thank you, Doctor, for the wonderful presentation. We've learned a lot within the short period of time. My question will be, you've talked about the risks, the two types of the risks, systematic and unsystematic risks. We talked about you touched them very widely, and then I follow up and I learned a lot. These two risks, which one of them do you think can be easily controlled? Because if I can understand from the presentation, the little I picked, I don't know whether I will be right. You can correct me if I'm wrong. Unsystematic risks can be controlled. Like it's more related to natural stuff and the like, which is difficult to control. I just want to know which one of these two kind of risks do you think can be within the control of an institution, systematic or unsystematic. And with regards to the formulas you gave here, the calculations of the formulas you've given, are they, what I've realized is like the formulas are the same as the same formulas we normally use in finance and stuff like that. So I don't know whether these are Islamic, the same thing is applicable in Islamic perspective of calculating, returns and stuff like that. Yeah, I just want to know whether there is any different at any point in time, or is exactly the same thing. Yeah, so those are the two questions I have for you. Thank you very much, Doctor.
Thank you, brother, for your questions. Pak Imam, you will directly answer the question, please.
Okay, thank you for your nice questions, yeah, Mr. Saiku Kasama from Africa, yeah. To answer your questions, I would like to deliver the nice research in one article, yeah. One article from Mr. What is it, yeah? Okay, yeah. The title is Risk and Return under Sharia Framework, an attempt to develop Sharia compliant asset pricing model SJAPM. Yeah. Maybe there are the few aspects about your questions here. How about the content of this research? A speedy emerging area of finance is the Sharia compliance financial systems. In first decade of 20th century Islamic financing has shown tremendous increase, and global volume has reached to 950 billions by the end of 2008. Being financial intermediaries in Islamic financial institutions have shown commendable progress in deposit collections under profit and loss sharing schemes. However, investments avenue are limited in comparison of conventional banks. Although a large number of financing models are available of IVS, yet maintenance of required liquidity of serious issues because money market and capitals of Sharia. Recently, Al-Mizan Investment Management Limited started screens of Sharia compliant stocks and provided an avenue for IVS to invest in equities. This study is conducted to understand conventional asset pricing models, document any mismatching with Sharia financial system, and suggest amendments to, if required, findings suggest existing model of equity pricings, JPM, EPT, MVM, are every much practicable under Sharia framework with slight modification of risk-free returns, because under Sharia framework, risk-free returns do not exist. It is the contents of relationship between risk and returns. Okay, maybe Mr. Dimas will add the answers about these questions, yeah, about the risk and returns in the risk management. Okay.
Yeah, actually, I'm not in the position of answering the questions, but there are two questions actually, Pak Imam, that raised by brother Saiku. The first is what among the two risks here, whether systematic or unsystematic risk, which can be easily controlled by banking sectors. And the second one, how Islamic perspective view the formula of risk management, Pak Imam.
Okay, yeah.
So the first question is one systematic or systematic that easily controlled.
Yes.
I will add it on, inshallah.
Yeah. I will quote in one book of risk management for Islamic banks, author Imamudin and et al. How to determining risk appetite. Risk appetite is the bank management tolerance for risk and the effort to create value for stakeholders. Since risk is an inseparable part of banking activities, the management must reach an agreement with regard to how much risk they are willing to take. The constantly changing situations in the around of the corporation means the risk appetite should ideally be subjected to periodic review and approval by the board of directors. And therefore, this context determination phase must include the following 7 measures. There are 7 measures. The first is the identification of risk within the domain of interest. Secondly, the planning of further risk management process. Thirdly, the mapping of social scope and identity and goals of every stakeholders and the risk management process. Fourthly, the criteria and basic assumptions of risk evaluations. Fifthly, the redefinition of the framework for various activities and identified agenda. Sixthly, the development of analysis criteria for the risk involved in the process. And the last, the development of analysis criteria for the risk involved in the process. Maybe it is the answers about your questions.
Okay, I think Brother Saiku, we can discuss in details later on, But if I may assist Dr. Imam a bit, or whether systematic or unsystematic risk that can be easily controlled, my humble answer is the unsystematic risk. Because in our understanding, systematic risks considered to be external shocks. The shock or the risk that cannot be controlled easily by the banks because it's out of their environments. But unsystematic risk, it is within the banking scope, within the banking operation, or within the banking capacity. Therefore, if you look at in this slide here, systematic risk is non-diversifiable. It means that it is very difficult to be diversified. And non-systematic risk is diversified. It means that it is easily diversified. So this is just short answer. Hopefully can satisfy your question. And the second one is in terms of formula, whether Islamic has their own characteristic in terms of the formula. You can see from the slide here, for example, here is just the general framework of the risk management in the banking or whatever is Islamic financial institutions, whereby risk could be in the form of deviation between the actual values and the expected values. It could be positive, it could be negative. But here we may understand that the formula here is based on the deviation from the actual nature of the risk, yeah, over time. So the formula from Islamic perspective here, maybe we can put in terms of the gain rate, whereby if we listen from the lecture from Professor Shahid Ibrahim last week, that the rate here not necessarily merely focus on interest rate, but also we have to focus on the Syariah. And also, if you remember what Dr. Rifki said last time, that we have to put also the spirit of spiritual, yeah, in the value. Therefore, the risk that we understand here in terms of the formula is, the formula should include not only the material rate, but also we have to put the values inside the formula, so that whatever the rate appear or emerge in the end of calculation, it should not be only covering the conventional perspective. It means that the material perspective, but also the spiritual perspective. Of course, along the way, the debatable issue will be coming out, yeah, if we discuss all this. Okay, Pak Imam, I hope I don't answer your question, but we can discuss inshallah tomorrow, yeah, for the subsequent speakers. Pak Imam, there's one last question, Pak Imam, perhaps here from sister from Jember, Pak Imam, in the chat.
Yes.
See question about the level of risk. The level of risk from the entrepreneurs. So whether the characteristic of the entrepreneurs could affect the level of risk that he would take in the business activities. It is the question, Pak Imam, whether the characteristics of the entrepreneurs could affect the level of risk in his business activity.
Okay, thank you, Mr. Dimas. And okay, thank you about the questioners from Jember. Yeah. If we discuss about the risk management, in this risk identification process, the assessment of potential customers can be performed through credit scoring, calculating the probability of non-performance, scrutinizing business plans, and observing the cash flows by which the customers plan to repay their liabilities. In the risk that an Islamic bank, especially, should identify are not limited to the risk it can control. Any and all risks that can interfere with the achievement of the Islamic bank aims and goals should be identified regardless of the bank's ability or the lack thereof to control those risks. For example, an Islamic bank has no control over the likelihood of losses caused by natural disasters like flood, but the prior identification of these risks can help the Islamic bank develop appropriate risk mitigation plans for their eventualities. Okay, it is the the answer about your questions. Okay.
Okay, Pak Imam, thank you. In short, actually, sister, the level of risk that the entrepreneurs would be taken, it is based on the expected rate of return that she or he would be pursued. For example, he would like to make the business is quite expensive, yeah. So the behavior of him perhaps would be risk taker. So he will take the level of risk higher because he would like to take the higher level of return. And the way around, if he or she would like to just get the average, not too much rate of return, of course, the level of risk will be risk avoidance or be risk not risk taker. So it is just based on the level of profit that he or she would like to pursue in terms of this business. Okay, Pak Imam and others, I hope that you can get some information from Dr. Imamudin about the concept of risk on return. If I may a bit conclude from his discussion is, the risk and return actually is interrelated. We cannot avoid the risk and ignore the return. So they are related each other. And their correlation actually is based on the two concepts, whether we would like to be a more diversified portfolio or we would like to be more concentrated portfolio. If we would like to choose the concentrated portfolio, of course, it will decrease the risk because it has low correlations. And the way around, if we would like to choose diversified risk, it means the risk is higher or it has higher correlation. So those things actually is based on the characteristics of risk, whether the risk is systematic or unsystematic. Those are the components that will be the factors that influence how the entrepreneurs or the banking sectors will react or behave, yeah, in regard of the risk. And the last one, if I may conclude also that the risk calculation actually is based on the standard deviations between the actual rate of return and the expected rate of returns. So you take the difference between both of them and you will get the calculations. And I think that's all, Pak Imam. Or
Yes,
do you
okay, thank
have
you.
any last speech, Pak Imam, or you have advice to us concerning the material or others, please, Pak Imam.
Okay, and the important aspects, yeah. If we discuss about risk and returns and the risk management, yeah, so we have to identifications, yeah, the terminology, yeah, the diversifications of investment, yeah, diversification to investment to diversification of risk. Yeah. Okay, it is the keyword, yeah, about this topic today. Okay, thank you, Mr. Dimas.
Thank you, Pak Imam, and dear participants. Alhamdulillah, we have been in the end of the program. And for your information, Dr. Imam is our 7 speakers under risk management lecture series. Inshallah, tomorrow we will be having another speakers from Universitas Muhammadiyah Yogyakarta, namely Dr. Suryo Pratolo. He is the Vice Director of Asset and Management at Universitas Muhammadiyah Yogyakarta, that he'll be talking about public sector accounting. So he is the expert on the area of accounting in public sector, and he is also the initiator of the we call it Beduk Mutu. This is the online platform for the marketplace. You can just search in the internet I just type here in the chat, yeah, beduk mutu. Yeah, here I chat here. You can just Google and search. This is the marketplace that UMY has, and it has been running for almost 3 or 2 years. And tomorrow at maybe 3:30 until 5 p.m. we'll discuss with him, inshallah. Okay, that's all for a while, dear participants.
Yes.
On behalf of the Third International Committee of International Summer School, Department of Economics, Faculty of Economic and Business, Universitas Muhammadiyah Jakarta, we would like to express our thanks and appreciation to all of you.
Okay.
And we end this session with Hamdalah together. Alhamdulillah. See you again, insyaAllah, tomorrow. Thank you, Pak Imam. Wassalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh.
Thank you, Doctor.
Thank you very much.
Thank you, Doctor.
Thank you.
Thank you.
Yeah.